Wing Yip Food Holdings shocked investors after its stock plunged nearly 15% in a single trading session. Whenever a stock drops this much, investors immediately ask two questions. Is this the perfect buying opportunity or the beginning of an even bigger crash? The company has recently regained Nasdaq compliance, announced a major private placement, and appears relatively cheap based on valuation metrics. But at the same time, profits are falling, cash flow remains negative, and technical indicators are flashing warning signals. So what should investors do? In today's video, we'll dive deep into both the bullish and bearish case, analyze the company's financial health, discuss the latest catalysts, examine the technical outlook, and finally answer the biggest question: should you buy Wing Yip Food Holdings right now? Let's begin. Wing Yip Food Holdings experienced one of its biggest daily declines of the year, dropping approximately 15% on July 17, 2026. Large one-day declines like this often create fear among investors. Some people panic, sell immediately. Others see the decline as a buying opportunity. But successful investing isn't about emotions. It's about understanding why the stock moved and whether the underlying business has changed. The recent decline wasn't caused by a single event. Instead, investors are weighing several positive developments against some serious financial concerns. That's why sentiment has become mixed. Let's start with the positive side. One of the biggest positive developments is that the company has successfully regained Nasdaq listing compliance. Why does this matter? Nasdaq requires listed companies to maintain a minimum share price. If a stock stays below that requirement for too long, it risks being delisted. Delisting can significantly reduce investor confidence and institutional interest. To avoid that situation, Wing Yip completed a 1-for-4 reverse stock split. Following the reverse split, the company maintained a closing price above $1 for 10 consecutive business days, allowing it to regain full Nasdaq compliance. This is important because the company remains listed on one of the world's largest stock exchanges. Institutional investors are more likely to remain invested. Liquidity generally stays stronger. The immediate delisting risk has been removed. Although a reverse split doesn't create business value by itself, maintaining a Nasdaq listing is certainly a positive development. The second major catalyst is the company's planned private placement. Wing Yip plans to issue 14 million new common shares to raise approximately KRW 22.4 billion. Now, whenever investors hear about new shares being issued, opinions become divided. On one hand, new shares dilute existing shareholders. On the other hand, the company receives fresh capital. Management intends to use these funds for working capital, purchasing inventory, research and development, business expansion, operational growth through 2027. If management invests this money wisely, today's dilution could potentially create long-term shareholder value. However, if earnings fail to improve, investors may see the share issuance as a sign that the company simply needs cash to survive. Execution will be critical. Another reason some investors remain optimistic is valuation. The company's price-to-earnings ratio sits roughly between 7.4 and 8.4. Compared with many companies trading at much higher multiples, Wing Yip appears relatively inexpensive. A lower valuation often attracts value investors searching for overlooked opportunities. Another encouraging point is the company's balance sheet. Reports indicate that Wing Yip currently holds more cash than debt. A stronger cash position provides flexibility. It allows management to invest, expand operations, and navigate difficult market conditions more effectively. Technical traders also noticed that the stock recently attempted to remain above several important moving averages. Although price action remains volatile, these levels could become important support if buyers return. Now let's discuss the biggest concerns. The company's earnings continue moving in the wrong direction. Recent financial reports show net profit declining by approximately 29.65% year over year. That's a significant drop. Even more concerning, analysts estimate earnings have been falling at an average annual rate of nearly 8.7%. Investors generally reward companies that consistently grow earnings. The opposite is also true. When profits continue shrinking, market confidence often weakens. Without improving profitability, even inexpensive stocks can remain undervalued for years. Cash flow may actually be a bigger concern than earnings. The company has recently reported negative operating cash flow, negative free cash flow, continued reliance on outside financing. This means the business is currently consuming more cash than it's generating. Eventually, companies with negative cash flow must either raise more capital, borrow more money, or significantly improve operations. While the recent private placement provides temporary financial support, investors will want evidence that cash generation improves over the coming quarters. Otherwise, future fundraising could continue diluting shareholders. From a technical perspective, the chart still shows weakness. Recent indicators include a technical sell signal, negative MACD momentum, and downward price pressure after breaking below previous support levels. Technical analysts generally prefer waiting until a stock establishes a clear bottom before entering new positions. Buying too early during a downtrend can expose investors to additional losses. Momentum remains one of the biggest short-term risks. Several developments could improve investor sentiment: higher quarterly earnings, positive cash flow, successful expansion using newly raised capital, improved operating margins, stronger revenue growth, and positive technical breakouts above key resistance levels. If these catalysts materialize, today's sell-off could eventually look like an attractive buying opportunity. However, investors should also monitor several downside risks: further earnings declines, additional share dilution, weak consumer demand, failure to improve cash flow, breaking below major technical support levels. Any combination of these factors could create additional downside pressure. So, should investors buy Wing Yip Food Holdings today? Here's my conclusion. The company certainly has several encouraging developments. Nasdaq compliance has been restored, fresh capital has been secured, the valuation appears attractive, and the balance sheet remains relatively healthy. However, the business still faces meaningful challenges. Profits continue declining, cash flow remains weak. Technical indicators have not fully turned bullish. Because of these mixed signals, I currently view Wing Yip Food Holdings as a high-risk speculative investment. Long-term, investors may consider adding it to their watch list and waiting for stronger earnings confirmation. Short-term traders should be cautious until the technical trend improves. Remember, never invest based on hype alone. Always perform your own research, diversify your portfolio, and manage risk carefully. What do you think about Wing Yip Food Holdings? Is this 15% drop a golden buying opportunity, or is the stock heading even lower? Let me know your opinion in the comments below. Thanks for watching, stay informed, invest wisely, and I'll see you in the next video.